Hello everyone, thanks for checking out my video. Wow, what a week we had. The S&P 500 lost 10% or 5 trillion market cap in just 2 days as Trump's tariffs plan sparked the worst meltdown since 2020. The US stock market has lost over $11 trillion since Trump took office. At the time of recording, the Nasdaq has officially entered a bear market with the Magnificent Seven leading the decline. It's really a massacre, carnage and bloodbath in the stock market right now. I wouldn't be surprised if there are portfolios that got margin caught and liquidated. It now makes us wonder, was 2nd April a liberation day or was it a liquidation day? And with Nasdaq already in the bear market territory, the important question would be, is S&P 500 next? Meanwhile, amid the chaos, I have dipped my toes in again for 4 companies. Yes, you heard it correctly, 4 companies. I mean, there were blood in the street last week. How could I have not stepped in, right? In addition, I have wrote some options, closed options, so new options and also let options expired. What an eventful week. So if you wish to find out more of the companies I step in for, updates on my options trades and my thoughts of the current stock market, do watch the entire video, alright? Alright, so what exactly happened last week? Well, all the drama took place on the last 2 days of the week as the market got absolutely wrecked on Thursday and Friday. It all started on Thursday, one day after Trump announced his global tariff plans. The stock market tanked. It tanked big time, dropping close to 5% that day. On the very same day, Apple fell around 9%, losing more than 300 billion of market cap in the process. The reason for the onslaught in the market was because Trump tariff plans were worse than expected. Basically, nowhere on earth is safe as Trump even slapped a tariff on 2 small islands with no humans, only penguins. And like I always said, the market doesn't like shocks and uncertainties, so this worse than expected tariff plans sent the market plunging down. And just when we thought it was bad enough, on Friday 4th of April, China announced their own reciprocal tariff against US. They basically hit back with an additional tariff of 34% on all US products from 10 April onwards, matching the extra 34% duties imposed by Trump. This particular move ramped up investors' worries that more countries are likely to retaliate than negotiate, leading to a prolonged global trade war. As a result, Wall Street panicked and the stock market gapped down again on Friday, with S&P 500 losing another 6% and Nasdaq officially falling into a bear market. The whole massacre on Wall Street has caused the $3 trillion club to disappear as the market cap of Apple, Nvidia and Microsoft all fell below the 3 trillion mark. To add on, the S&P 500 ended the week with its worst weekly loss in 5 years since 2020. What a terrifying week for the stock market. By the way, just to share something, I personally find it quite interesting. So last Friday, just before Powell were to speak about the economic outlook at a conference, President Trump lashed out at Powell by asking him to cut interest rates and stop playing politics. Trump also taunted Powell by saying he's always late to cut interest. But interestingly, Powell reacted by saying that it is too soon to determine the appropriate policy path. He further added that the tariffs are higher than almost all forecasters expected, but they still don't know where it will come to rest. He also shared that the outlook is highly uncertain with elevated risk of higher unemployment and higher inflation. Finally, Powell said that the Fed is well positioned to wait for greater clarity before considering policy adjustments. To summarize all this in layman's terms, Powell is basically saying, F you Trump, we are not cutting rates yet, we are just going to wait and see. It's kinda interesting, right? I mean, Fed Chair Powell and President Trump are publicly fighting about interest rate cuts. Okay, for the week ahead, the shell shock market has to brace for more tariff tensions. More tariff headlines and volatility will be installed ahead of the 9 April deadline, which Trump has set for his reciprocal global tariffs to take effect. Some investors might be hoping that Trump would negotiate deals in the coming days with some countries that would roll back some of the tariffs, something that Vietnam has done. In fact, Singapore is also planning to engage the American counterparts on the blanket tariff of 10% on all countries. That being said, many others remain skeptical about this whole negotiation thesis, as major players like China and the European Union might not budge to Trump's demands. Anyway, with tariffs casting a shadow over the economy outlook, investors are getting more and more cautious as they welcome the new earnings season this coming week. Major US financial institutions will be reporting their quarterly results and financial forecasts. This includes JP Morgan, Wells Fargo, and BlackRock. In the meantime, the market is going to receive another new set of inflation reports this coming week as well, namely CPI on Thursday and PPI on Friday. The numbers could help to set a baseline for US inflation ahead of the impact from the tariffs, which are widely expected to add to the pricing pressures. Moving on, let's read some charts. Well, the market is getting smoked right now, so let's look at SPY to see where the broader market is bringing us next. First of all, if you could recall, I shared 3 bearish signals on SPY chart last week, and specifically on this bear flag, I mentioned that if it plays out, we will hit low 500 at least. Look at where we are now, back to where we were back in August 2024, during the yen carry trade sell-off. I hope that could earn the like button from you. So what's next? Okay, before that, let me clarify why did I mention low 500 last week, also to share with viewers the movement of a bear flag. So during a breakdown of a bear flag, the downside can be as huge as the flagpole or even larger. So in this case, it means we could see SPY falling to 480's range at least if a full bear flag breakdown completes. But as we all know, all these are just textbook knowledge. Therefore, I wanted to be a bit more conservative last week by saying we could see minimally low 500s, because that's where the 161.8 Fibonacci level is, which could act as a support. Well, the target has now been reached. What's next is pretty important. SPY needs to reclaim this 161.8 Fibonacci level as soon as this week, which is around 509. Because if it doesn't, I'm not kidding you, SPY could easily break below 500 and possibly head towards the 480s range that I mentioned. When that happens, SPY would officially be in the crash or bear market territory, which is defined as 20% of its peak. Anyway, just to share, this teardrop kind of breakdown is very rare and very bearish. But before the bears get all too excited, I wanted to highlight that such double gap downs means that the market is hitting oversold level. Therefore, a relief rally could come anytime before the next possible dump. Okay, that said, don't bother guessing whether will the market dip a little bit more before it bounces up, or will it rebound on Monday or Tuesday. Let the market do its thing and we follow after. In short, I'm pretty sure a short-term bounce will come, it's just a matter of time. The key thing lies at what happens after the bounce. My view is any relief rally will likely see sellers stepping in, unless this whole trade war has some certainty. For any bullish thesis to materialize or for any signs of turnaround other than certainty from the trade war, technical-wise, SPY needs to reclaim the 200 moving average. Otherwise, the overall trend is still bearish, and it could be the short the pop moment for market makers whenever there is a rebound. Moving over to Apple, similar to SPY, my last video shared that if this bear flag breaks down, the downside can be massive, and we can expect Apple to visit low 190s at least. Look at where we are now, 188. Alright, what's next from here? There's one important level to watch on the downside, and that is the 161.8 Fibonacci level at around 182. If that breaks, then I think there is a very high probability for Apple to fill that gap between 172 and 179. Then from there, if there are more negative news from the tariff front, we can expect to see the full flagpole worth of downside, which means we could see Apple going below 170. One more thing to highlight, can you see that 50 moving average is about to cross below the 200 moving average? If Apple cannot pick itself together this week, then I think that death cross could happen. And when that happens, well, I covered that in Nvidia section in the last 3 videos, check them out. But basically, the death cross will be the nail to the coffin, where we will likely see Apple in the 170s and even 160s range soon. As for bullish thesis, I'm not sure if there's still any bullish thesis to discuss right now. Anyway, for a start, or for any potential sign of reversal, Apple needs to get back above the psychological level of 200 as well as the green line that I drew, which is around 205. If only Apple can close above this 205 level, then it's worth to start talking about reversal. Otherwise, any form of short-term bounce is still bearish. Moving over to Tesla, well, among the 3 bear flags that I covered, this is the only bear flag that hasn't really broken down yet, but it's flashing warning sign already. For this coming week, watch for 2 things. First, a potential bearish MACD cross. Second is the recent low of 217. If 217 gets breached and we get a bearish cross on the MACD, wow, check out the chart. A bear flag breakdown could easily bring us towards 124, where the 161.8 Fibonacci level is. I know it sounds super duper crazy. I mean, from the peak of 488 to 124, that's a 75% crash. Okay, I'm not here to spread fear, and as much as I am a Tesla bull, I want to be objective in presenting my technical analysis. I'm basically just reading things off the chart and deliver the message to the viewers, so don't shoot the messenger. In fact, I'm equally shocked when I look at the chart, but I need to remind myself that this is the stock market. One should not invest or trade with emotions. I should not get blinded by emotions or just because I am a Tesla bull. Alright, sorry, I digressed. Anyway, one saving grace is that not all bear flags will break down that much, so there could still be a chance that things are not as bad. But even so, a break below 217 and the psychological level of 200 will give it a high probability to at least fill that gap between 147 and 157. One more thing. Again, objectively speaking, there is a bit of consolidation at 180's range, so that could be a potential bounce area. But if it doesn't hold, then 150's and 140's range could be inside. On the other hand, for us to visit the bullish thesis, we need Tesla to close above the green zone at least. As you can see, this area acted as a resistance zone on multiple occasions, so this is the very first obstacle to cross. From there, if possible, go above the 200 moving average at around 288. Honestly, that's gonna be an uphill task. Investors can only hope for positive catalysts from Trump, perhaps something that benefit Elon Musk or the automobile industry. But then, I need to remind viewers that hope is not a strategy. Let's now hop over to Google. In my previous video, I shared that we should be prepared for Google to break below 150 and test that September 2024's low of 147. Once again, there you have it, Google did exactly what I shared. Meanwhile, can you see there is a gap below the current price? The range is between 142 and 145. So don't be surprised if this gap gets filled this week. What happens after the gap fill is critical. If Google bounces off from any point in the gap range, then we could see a nice short-term technical rebound. But whether this is just a dead cat bounce, it will depend on whether Google can break above that green zone, which is between 160 and 162. However, if Google doesn't bounce from the gap area, I think we can expect to see Google back in the 130s range again. If we do reach that level, wow, the valuation is pretty ridiculous in my opinion. So all in all, anything below that green zone, the trend for Google is still bearish. And before I forgot, watch for a potential incoming death cross. As shared earlier, if a death cross happens, we can expect the bearish trend to continue. Moving over to Meta. Wow, finally Meta has broken below the 200 moving average, something that I have warned previously. Among the Mag 7 stocks, Meta is the last to break this level. To add on, in my last video, I shared that if we get a combination of a MACD bearish cross and a break below 200 moving average, the downside can be quite a fair bit, probably towards the second green support zone at 540's range. But Meta proved me wrong, it went even lower to sub 500. Anyway, I don't think you need me to tell you that the trend is very bearish for Meta as the share price sliced through my 2 green support zones like a tofu. So for any sign of reversal, very simple, Meta needs to punch through both support zones like a tofu as well. Otherwise, things are still looking bearish, and if you had realized, we are back in this big consolidation zone. The range of this area is between 450 to around 540. It's a huge range actually, which means if the broader market continues to dump, don't be surprised if Meta drops towards the 450s range before buyers start stepping in. By the way, just to do a quick math, from the all-time high of 740 to 450, that's a whopping 40% drop. Wow, can you imagine that happening? I don't know if it will happen, but I have already stepped in for Meta last week. Moving on, let's check out Microsoft's chart. Once again, I need to bring out my last week's video's analysis, where I shared that if Microsoft goes below the consolidation zone and combines it with a MACD bearish cross, it means the market makers have chosen their side, which is the downside. That's when we could waterfall to 360's range, and yep, we got that. In fact, it went as low as 359. As I zoom out the chart, you will be able to see another consolidation zone, a tiny one actually. The range is between 360 to low 370s, and right now it spells deja vu, because prior to the latest meltdown, Microsoft was flirting with the bottom of the recent consolidation zone, and currently it is at the bottom of the mini consolidation zone. This means that if 360 breaks, it could be another meltdown moment. I really don't see much support below until low 340s range, and below 340 it will naturally opens the door for more downside, probably as low 300s. But I think it's quite unlikely to happen this week. If anything, we should have a technical rebound or oversold rebound first. If a bounce does come this or next week, Microsoft has a lot to do before we can even discuss about a potential reversal. I think the share price needs to get to the top end of this consolidation zone at least, which is around 396. Last of all, let's have a look at Nvidia's chart. Wow, Nvidia has breached my last line of defense, which is the green support line at around 95. I shared in my last video that if that breaks, I'm not kidding you, we can say hello to 80s range. And I do believe that this thesis is still intact as long as Nvidia trades below 95. Which means this coming week, if Nvidia doesn't quickly get its act together by closing above 95, we could feel that tiny little gap at 86 and 87. From here, if we don't see a technical rebound, pay special attention to this consolidation zone. The range of this zone is between 75 and 95. This means that Nvidia may slowly grind towards the 70s range in the coming weeks. On the other hand, if an oversold rebound happens this week, I think Nvidia could easily close above the green line at 95. I wouldn't even be surprised if the bounce further pushes the share price up in order to fill the two gap downs, which means we could see Nvidia climbing over 105. Okay, if this happens, don't be too excited yet, as with all other oversold scenarios, a technical or oversold rebound is very common. It's how the market reacts after the bounce that matters. Be very careful that market makers may bring the share price above 100 to fill the two gaps before dumping it back to 80s range. Alright, it's time for options trading segment. Before we dive in, I just want to say this. In volatile times like this, I remain fully committed to staying transparent with all of you. Every single one of my option wheel trades will still be shared week in and week out. I know for the past 1 to 2 years, I was regularly showing how my sell put contracts were expiring worthless and how I was happily pocketing all those juicy premiums. But in this current environment, not every single trade goes as planned. Some don't expire worthless, I had to take assignments, I had to roll contracts, etc., which is all part of the game. The key thing that I want to say is I'm not going anywhere. I will continue to show you exactly how I navigate this volatile and downtrending market through all my option wheel trades. Okay, without further ado, let's check out the trades to update this week. Total 5 of them, all summarized on this page. First up, it's this cash secure put on Nvidia with $100 strike price. It was supposed to expire last Friday, 4th April, but one day before Liberation Day on 1st April, Nvidia was trading below 110 during most part of the day. And given so much uncertainty around Liberation Day, I decided to take profit by closing the position, which means to buy back the put contract that I sold back in February this year. Back in February, I received a premium of $165 for selling this put option, and last week I bought the contract back by paying $30. So basically I earned about $135 for this trade, less transaction fees. And boy, luckily I took profits off the table because by now you already knew what happened towards the end of last week. There was a carnage in the market and Nvidia broke below $100. The second and third trades are cash secure put on Google with a strike price of $160 and cash secure put on Microsoft with a strike price of $385. Both were supposed to expire on 4th April Friday as well. But then on 3rd April Thursday, one day after Trump announced his global tariff plan, the market tanked and I knew both stocks were unlikely to close above their strike prices by the end of the week. Therefore, I quickly wrote both options to avoid assignment. The new strike price for the Google contract is $155, while the revised strike price for the Microsoft contract is $275. Both contracts will expire on 25th April. By rolling these options, I basically give them more time to recover. Moving on, the fourth trade to update is this cash secure put on Tesla with a strike price of $200. The contract was sold on 27 February when the share price was in the 280s and 290s range. The reason for selling this put contract back then was because Tesla hit the 200 moving average support level and both the 6-day and 14-day RSI were at oversold levels. This gives us a decent probability to see a short-term rebound. But unfortunately, Tesla went further down and the bounce only came towards the end of March. And despite last Thursday and Friday's crazy sell-off, Tesla managed to close above the $200 strike price and the contract expired worthless, which means I got to keep the full premium of about $200. Alright, the final trade to update is this new cash secure put on Nvidia sold on 3rd April Thursday. The strike price is $85 and the contract will expire in 9 May. So what happened was that on 3rd April, the market gapped down and Nvidia was down close to 8%. The RSI was also reaching oversold level. So I saw this as an opportunity to sell a put option in anticipation of a short-term bounce. The bounce can be a dead cat bounce or a relief rally, it doesn't matter, so long as Nvidia gets a small bounce before 9th of May and stays above $85, this contract should give me some profits. But that being said, unfortunately, the market continued to sell off after I sold this contract and the trade is currently sitting on a huge paper loss. Let's see how things pan out eventually. Meanwhile, just some words of caution, selling put options during this period is a very risky move. Do it only if you know what you are doing, only if you have a clear trading plan and is prepared to take assignment anytime. Alright, let's move into the final segment of the video. This part is going to be a little longer than usual because there's quite a bit of things to unpack. But before diving in, I want to start by showing you the losses in my portfolio. As of now, my portfolio is down around 15% year to date compared to the S&P 500's 13% and the Nasdaq's 19%. Just last Friday alone, my portfolio saw a paper loss of about 12,000 US dollars. That's roughly 16,000 Singapore dollars. And with multiple options positions active, my portfolio risk level has shifted from safe to moderate. So why am I sharing all this? As I've mentioned in the options trading segment, I believe in being transparent. I don't want to just only show the green days or highlight only the wins. By sharing the losses too, I hope to offer some reassurance to viewers who are going through a tough time. Just want to say you're not alone, no portfolio is invincible, unless you're Warren Buffett maybe. Though, to be fair, what we see in this table is his net worth, not his full stock portfolio. That being said, credit to him for trimming his Apple stake and the other positions ahead of this market meltdown. Okay, despite these losses in my portfolio, I still dipped my toes into the market last week and bought 4 companies, and they are Meta, Microsoft, Google and Nvidia. Alright, a quick disclaimer, this is not financial advice, I am just sharing what I did. So the reason for buying is simple. Buy when there's blood in the streets and buy when others are very fearful. As you can see, the CNN Fear and Greed Index closed the week at 4, which is in extreme fear territory. You don't see this very often. Maybe the last time was during the COVID period when it hit 2 or 3. But of course, some people believe the worst isn't over, that the dip could go deeper. Some ultra bearish folks are probably waiting for the index to hit 0 or even negative. But I just want to say, you do you, I do me. Everyone's got their own game plan and this is mine. The key is to have your own strategy and stick to it. Okay, take Nvidia for example. When it was trading around 140 or even 120, I'm sure there are investors who said they should have bought it when it was below 100. Well, it's now nearly 40% off its all-time high, and here's the dip below 100. So here's the question, are those investors buying now according to their plan and wish? I wouldn't be surprised if some want to wait further, wait for 80 or even 60. Anyway, I can't speak for them, I can only speak for myself. And I've said before, if Nvidia dropped below 100, I would buy. And so I did. As for the other stocks, Microsoft hit its 52-week low. My thinking was very simple. The stock price is back to where it was 1 year ago, but earnings have grown. Sometimes it's best not to overthink. Then for Meta, I had marked out the green support or buy zones earlier and I stuck to the plan by picking up small amounts in each zone. In case you didn't do the math, Meta is currently on a 30% sale from its all-time high. Finally, for Google, if you had followed my recent videos, you would know that I got assigned 100 shares at 175, and that's 17,500 US dollars or over 23,000 Singapore dollars. But when the share price fell below 150 last week, I added more. To me, the valuation looks too attractive to ignore. Again, not financial advice for you, please do your own research. Looking at these purchases, you will notice that they are all in software, advertising and social media industries except Nvidia. These companies don't sell physical goods and are not really affected by tariffs. And as of now, semiconductors are exempt from Trump's new tariffs. So the recent sell-off in companies like Meta, Google and Microsoft feels a little excessive and overreaction to me. Yes, the bears can argue that if a recession hits, all businesses will be impacted, and that's fair, but I believe this is the time to accumulate shares and wait for the eventual recovery. And could prices drop even further? Absolutely. Again, you do you. Some prefer to wait for a clear sign of turnaround. I prefer to dip my toes in gradually, and if the market turns around, I will deploy more cash. Also, just to add, the VIX, which is the Fear and Volatility Index, is now above 40, which is the highest it has been since April 2020. Historically, when VIX hit this level and investors buy in, their portfolios tend to do well 5 to 10 years down the road. Of course, the usual caveat applies. This only works if you are investing in fundamentally strong companies, not meme stocks, not speculative bets. Before we wrap up this video, I just want to touch on margin calls. If the sell-off deepens this week, leveraged investors might get hit with margin calls, which could force even more selling and will drag the market down further. That's the horrible part of market crashes: forced selling, liquidations, and panic. Therefore, I thought to put it out here first so you don't panic if the market drops further from this point. And my view is, stay calm and avoid leverage if possible. Don't let margin wipe you out. Finally, let me leave you with two quotes. The first one is from JP Morgan. In bear markets, stocks return to their rightful owners. And the second one is from the legend Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. Warren Buffett has patiently spent years building up cash, and now he's just sitting on his mountain of money, waiting to buy your panic at a discount. That's why I have also been accumulating cash over the last 2 years during the bull market. And just to put things into perspective, last week was my biggest week of buying as compared to any week in 2023 and 2024. I've been waiting patiently for this buying opportunity. Even with last week's purchase, I still have quite a fair bit of dry powder on the sidelines waiting to be deployed. So later on, after patiently waiting to buy the dip, the next phase is again about patience. Hold on to your fundamentally strong companies right through the storm, and in time to come, the returns should follow. To end this video off, just one more quote, this time from Fed Chairman Jerome Powell. A year from now, the uncertainty should be much lower as the impact of Trump's policies become clearer. So until then, hang in there and let's write this out together. If you have stayed till here, it means you have listened to a 10-page worth of essay. Thanks for watching. Don't forget to hit the like button if you found this useful, and I'll see you in the next video.